Good morning, good afternoon, and good evening, real estate investors. Hope you're doing well today. Got a great episode in line for you. Now, we knocked it out of the park with an episode with attorney Alan Chesker talking about owner financing, wraparounds, assumptions, subject to deals, and stuff like that. And I've been working to get on a Texas RMLO to talk about owner financing in the greatest state in the world, the Lone Star State, Texas, out here. Because I know not only if you don't live in Texas, you'll want to live here, all right? And if you don't live here, you'll want to invest here in one way or another. So we have got a legend who's been around for over 2 decades in the mortgage business, over 25 years. She got started when she was just like 3.5 years old, everybody. Okay, so she's been doing this for a while. Highly recommended. We had a great conversation about a week and a half ago, and she's like, "Yes, I want to be on." I'm like, "We're glad to have you on to talk all things about lending in Texas, whether it's traditional or financing stuff." So we got the amazing Nirvana Roof joining us here today. What is going on, Nirvana? You're rock and rolling on a Monday?
I am. Thank you so much. I'm so happy to be here. I love doing podcasts and different events so that we can really inform people of what it's like to do wraps in Texas. Because yeah, like you said, everybody either wants to live here or invest here. And Texas is very friendly to investors. A lot of states I've found are not friendly to investors at all, at all. So, and it's a great market, the very great
It
market.
is a great market, and we got so many different cities, obviously, with Houston, Corpus, where I grew up, or Austin, San Antonio, of course, DFW. Now, you said you bounce around quite a bit. Where in the world are you at today? Where in the world is Carmen Santiago today? Is the Nirvana Roof?
Yeah, so I am sitting in Arlington, Texas
Okay,
today. So that's
today.
where I am currently. My home office is in Houston, and that's where I had actually been physically for the last 15 years. Kids flew the nest, and I really wanted to focus on my RMLO company and on my business. So I have a ton of clients up here in the Fort Worth, Dallas area. So I moved here to be close to them. And then, of course, once I got introduced to Alan Chesker's group and started speaking with them, I now am basically in Houston, Dallas, San Antonio, and Austin at any given period of time, speaking and really trying to educate investors on RMLOs and reps.
So let's talk about what's so unique about the Texas market when it comes to, say, owner financing a property. Where's some of the biggest hurdles or the biggest things that people need to come to mind? And you'll probably say one thing, and as a note buyer, I'll probably throw in, and we got
Yep.
people have to keep this in mind as well. So it's going to be great for you guys out there that have all the questions.
Absolutely. So the biggest thing is that there's two different types of ways to do wraps, right? So there's if I, as an individual or an investor, own a piece of property outright, and I just want to own or finance it to someone. In those transactions, to me, that's truly an owner finance transaction, right? So there's that, and then there's a wrap, what I call a true wrap. And that's when one of my investors will actually go out and purchase a property for a buyer and then wrap it to them. So we have that. And then we have like Alan Chesker's area, an arena of expertise. And that's that subject to, which he hates that word, or unqualified.
Assignments, assumptions, as he like to say. It's an
Yeah,
assumption. Yes,
non-qualified assumptions. Yes, I think that's what he got.
that's
So
exactly right.
with those, of course, you have a homeowner who is in a situation, and an investor will come in, take over that note, and then wrap it to who we call an end buyer. So there's kind of three different ways to do a wrap with what I'm familiar with.
That's
Um,
100% accurate. So let's talk about what are things that people, if they're going to offer owner financing or a wraparound, what makes your job easier or what makes it difficult?
So regulators, of course, are what's making everything difficult. Texas did actually put a wrap mortgage, I think it's the 5.016 on the Texas Constitution. They put a wrap law into place in January of 2022. So in 2025, they have started auditing those loans. So I literally, my RMLO company, which has been in business for 3 years now, I just got audited. My audit wrapped up on Friday. It was brutal. Now, mind
Yeah.
you, I have been in mortgage for 25 years. I have been audited by the state, the NCUA, the FDIC, all of them, CFPB. I have been audited by all of them. This was the toughest audit I think I've ever been in.
So
Because
let me tell folks a little bit about that because when I ran a mortgage company, we got audited as well. And what it is, if it's still this way, where you have the regulator come in, they ask for a list of your files, they pick like what 10, 15, 5, whatever, how many you've done for it, and then you basically go get those loan files and hand it to them, and they go through and double check it. And if it they comb through it, everything's good, great. If there's a question, they ask about it. But if you get through everything, then they're like, okay, give you a check and move on to the next one, right?
yeah, so because it's so new, I think they audited five.
Okay.
And they picked, well, they looked at my entire call report, which was about 250 loans or something
Right.
like that. They pulled five, and those were the five that they truly audited. But she told me when she first pulled or requested the file, she goes, I just want you to know, we haven't figured out how to audit these yet. So we're still learning. And I'm like, oh, this is going to be great, right? This is going to be great.
Uh-huh.
So I got done with it. I survived, and I drank a lot of wine during the whole thing. Just I will disclaimer. Yep. So I'm going to be sharing new information with your people that I haven't even rolled out to my own people yet. So you
World
guys,
premiere here, everybody.
yes,
Cutting edge podcast.
yes. So if you are an investor who is doing wrap mortgages in the state of Texas, actually nationwide, if you're doing owner financing, seller financing, or wraps, you are allowed to do 3 transactions per year. Now, that is not a calendar year, that's your year. So if your first one is in July, you've got until July of the next year. So for everybody who does 3 or less per year, keep doing what you're doing, you're having a great time. Unless, of course, you want to sell your notes, then you'll want to hire an RMLO because note buyers will pay a lot more if you've used an RMLO. So I'll plug that in there.
Mm-hmm.
So from number 4 in your year on, you are supposed to become a licensed mortgage company. It is no longer just a licensed loan officer. You have to actually be a licensed mortgage company in order to do any more reps. So how this is happening and how they're finding out is they're auditing RMLOs. So when I got audited, of course, it said right on my audit, working with unlicensed entities. So it listed my investors who had done more than 3 transactions with me and said, you did this many loans with an unlicensed entity. So that's how they're finding out, of course, because they're seeing who the lenders are. And of course, you can't skirt around the 3 by having multiple entities because they look at the actual owners of those companies. And they did. I didn't even tell them who the owners were. They looked it up and they saw, and it's noted right on the audit. So that is being audited and that is being driven home. And your
So
RM, go ahead.
So when you talk about, okay, so this is good stuff. I love this. So when you talk about being a licensed mortgage company, let's talk about that real fast before we dive in. So what does that mean? It means people need to go get their loan officer, mortgage broker's license and set up a separate company for that stuff.
Yes. So what that means is that especially in the state of Texas, it's a little bit different for every state, but I can speak specifically to Texas. So in order to have a mortgage company, or my kids have a mortgage brokerage, but a mortgage company, which is what the lenders or investors will be required to do, they have to register with the NMLS. They have to have a mortgage broker of record. So, like myself, I actually offer it as a service to my investors. I will be a broker of record for a fee, of course. But the other thing is you have to have a licensed loan officer employed by your company. Now, what I did find out is that that loan officer doesn't actually have to be the one to originate the loans. They just have to have one on record for the purposes of having the mortgage company license. So I am a mortgage or a broker of record for a company, and I happen to have a spare loan officer laying around that wasn't working. So I plug him in there. We pay him a couple bucks a year. He just takes his, CE class and they're good. So I'm trying to dig up a couple more loan officers, but non-working loan officers are a little hard to find, So I have another investor who coming up, he is having his wife become a loan officer. She's going to be a loan officer for the company just to get their mortgage company license, but she's not going to actually do it. So I can still be the RMLO, or you can still hire an RMLO, but in order to have an actual mortgage company, you will have to have a loan officer parked in there.
This can't be, if I'm the investor and I'm going to be doing a lot of these per year, I have to go get my loan officer's license, start a company, and then can I be the loan officer of record on that as well? And you're the broker?
Mhm.
Okay.
Yep.
So
Yep.
the person that runs the company is doing this can't be the same loan officer.
Yep.
Okay. Okay.
Yeah. Yeah.
Now let's
Yeah.
talk
That's okay.
about, so it used to, back in the day when I got my
Yep.
loan officer, this is obviously how it's changed. Obviously, like I used to, if I passed my, was it my series, my group 14 or series, whatever, where I got my life insurance license, which is a state
Yeah.
test. All I had to pay was $200 to the state of Texas to start doing loans. That's
Yep.
not the case anymore, right? No.
No. No, I think attorneys though.
Attorneys are the
Attorneys
exceptions.
can.
Yeah. Yeah.
Yeah, I think attorneys can, but no, just regular old everyday people. The nice thing is though, is to become a loan officer, if you have financial background, that does help a little bit too.
Yeah. Your experience goes into that there. But
Yeah.
what is it? It's good for 2 years. Then you gotta have how many hours of CE every year or every other year, something like that?
Yeah, so it's 8 hours of CE every year. Texas did away with their own. They used to have an extra 1 hour class. They did away with that. So now in Texas, it's just an 8 hour CE every year, which is like $100
Yeah, that's pretty
and,
easy because
and the license.
there's different events you can go to that you'd pay to go to that would give you additional CE credit. That's not so bad. But
Yep.
do you have to go pass the state test to be an
Yes.
LO? Okay.
Yes. So you take a 20-hour class, and that can either be done online or in person. And then you go and you pass the test, fingers crossed. You have to have a 70 to pass the test. And then once you get that, then you're registered with NMLS, and then you can apply for the mortgage company because you have to have that loan officer in order to have a mortgage company.
Okay.
And they will, like if you start the application, because I did have this happen with one of my companies, they started the application for the mortgage company, but they didn't have their loan officer lined up. So their loan officer took too long. So their application got canceled, and it cost like, $800-900 to apply. They had to pay that again. So you
Oh,
don't want to apply until you've got everything because you'll lose
right.
it. Yeah,
Yeah. Okay. Well, I mean, I always find that there's a bit of a cost of doing business. It kind of separates the cream from the crop. You know what I mean? People that will do the extra
absolutely.
stuff to do that. And this doesn't include if you're owner financing. That three doesn't include if you're owner financing your own personal house, though, too. That's an exception, right, Nirvana?
Correct. Correct.
Okay. All
Yeah.
right.
So you can do your own personal house and then 3 that you don't own. Yep.
In a
Yep.
12-month rolling period from the
Correct.
time that you start your first one. Okay.
Yep.
All right. So we've got that requirement up. Now, with the
Yes.
audit, so they pulled up the LLCs or the up companies. It's okay, you're working with a non-licensed company or non-licensed individual. Is there a penalty to you or a penalty to them? Or how's that? They don't know yet?
They don't know yet. No. So I'm waiting to find out if I'm going to get what's called an administrative fine. They're not going to shut me down or anything. Typically you just get a crappy rating and you just fix it all. And then when they come audit you again, they just make sure that you're not doing that stuff again. None of this, by the way, bothers me or concerns me in any way, shape, or form. It's all learning curve, right? And for
Right.
something that's never been audited, you don't really know what you're up against. And like a fool, I made the mistake of kind of mirroring another RMLO company that had been around for a really long time because I had a specific client that was using that RMLO and had been using them for a long time. And I was doing their acquisitions with one of my other companies. And they loved the way that I did business for my acquisitions. And they're like, would you please become an RMLO? So I kind of dove into it. I'm like, yeah, I said, no, I'm good. I dove into the rules. I said, it's really not that different. But they were like, well, there's specific things that this other company does that we really like. Will you do it? And I was like, sure, why not? Shouldn't have done that.
Now, was that
Shouldn't.
was that RMLO located in Texas, or where were they located at?
I am not going to say.
Okay, we'll talk off camera there. We won't go
Yeah,
too
yeah.
further for you. So
But
when
come
you
to
say
find
acquisitions, you're saying that that the other RMLO company was originated, and then you were buying it or taking it over, or what do you mean by the
no,
acquisition
so
side?
this was a type of investor where they buy a property and then wrap it.
Okay.
So I have another company. So my other company was the mortgage company to help them buy that property, and then they were using an RMLO to wrap
Oh,
it.
okay.
Yeah,
Yeah, okay. That makes
yeah,
sense. Okay.
yeah.
Now, if what's it cost for somebody to use RMLO to qualify their owner finance buyer? What are some of the hurdles or things that people, if you're doing, doing 1 year, you should use an RMLO to originate
Yeah.
it. But what's that process look like, cost and things that your owner finance buyer, the borrower, needs to bring to the table?
So I have two different options with my company. I have like what I call my mini service. My mini service, that's kind of stated income, stated assets. I don't really verify anything, but I will pull credit. And I'll, based on the stated income, stated assets, I'll give the debt to income ratio. I provide the credit report. So that service is 550, 550 just for the baseline, and then 700 with the credit report. And of course, that's for my time and my expertise and the
Sure.
credit report, which are expensive as heck nowadays. So I charge that, but for my full compliant service, it's 1100.
Oh, that's not bad at all. That's actually really good
Yeah.
on that. It's for you because then you're pulling it. And are they filling out like a 1003 application to make it easier for you on that for the most part?
Yes. So I typically I'll send an email to the buyer with a fully compliant normal mortgage application. I like to use that because it also integrates permission to pull credit, e-disclosures, all that kind of fills in all the government stuff. So I'll get a full application, I'll pull credit, I verify income, verify assets. But of course, on the RMLO side with owner financing, that can get creative, right?
Hmm.
So this is where you differentiate between a typical Fannie Mae or government loan. Most people who are doing owner financing, they either haven't paid their tax returns in a long time, or they've filed their tax returns but they like to write everything off so they don't qualify. um, or of course they get paid cash. My favorite income analysis for RMLOs is bank statements.
Hmm.
Take 12 months bank statements. If they get paid cash, as long as they put it in the bank, I can calculate income that way. If they haven't paid their taxes, I don't care. I look at the deposits, so that's my favorite way to do that. But I have gotten creative. I
So,
have gotten
because if
creative.
as long as they can provide receipts, let's just put it that way, with money
Yep.
coming in, or they've got child support or something that's coming in on an annual basis, for an investor getting fix and flip, showing okay what kind of profit came into that versus expenses going out, that kind of stuff.
Yep.
It's not you're not asking for W-2 tax returns in a lot of cases.
Right. Right. And
Um,
I do have borrowers who are W-2 tax, like I can do all that. And the only thing stopping them from a traditional mortgage is, let's say, their credit report or their credit
mhm,
score,
mhm.
so it just depends. It depends on the borrower. It depends on the situation. And I kind of ebb and flow with whatever we need to get the information, because the regulation itself, the main thing that it drives home is the ability to repay. Right. So you don't ever want to put who I call an end buyer in a situation or a property that they don't have the ability to repay. If they can't prove that they can pay that mortgage, you don't want to put them in that property. You're asking for a foreclosure.
So that was always the big thing. I always It was my big thing when they did the knee-jerk reaction back in 2008. You have to basically prove that they have the ability to pay. Is it 3 years still, basically, or has that changed? Huh?
Two.
2 years. Okay,
Yeah,
that's
two.
good because things a lot can still happen in 2 years, right?
Oh yeah, no, I remember that. I remember what was it, CISA, stated
Yes.
income, stated asset.
Yep. Yep.
Yeah, it was I remember I worked at Bank of America at that time as a loan officer. And I remember people sitting in front of me saying, "Oh yeah, I make, $300,000 a year and I want to buy this $500,000 house." And I'm like, "Well, what do you do for a living?" And they're like, "Well, I work in housekeeping at the La Quinta." I'm like, you do not make $300,000 a year. And I think that's where why brokers especially got a really bad rap back in 2008 is because they were just taking that information and getting loans for people. And then of course you were dealing with the interest only and the pick a pays and all these things. And it was like the whole regulation that allowed that to happen it was set up doomed from the beginning.
Yeah, I mean, everything run rampant. It was easy for folks then to jump in and like what happened with MeriQuest creating fake bank statements and stuff like that. It
Yep.
was ripe for fraud. On some cases, not. I would say it was a few bad apples ruined the whole damn bunch. You know
Yeah.
what I mean?
Yeah, but
Um,
I will say that's something that we're going to start seeing more and more of with AI. Actually, from and with my other company, I was working with a lender, and they actually did the underlying mortgage for my client who does a lot of these wraps. So they figured out because we never told them we were wrapping, but we never lied about it. And my clients were very, very qualified for the loans and they bought them as investment properties and we did
sure.
nothing wrong. But they actually got hit with a fraud ring out of Delaware. And that fraud group in Delaware was doing the bank statement program, which is what my borrowers were doing. And come to find out, they were using AI to create full fraudulent bank statements. And this lending company lost millions and millions and millions. So they went back and were looking at their whole portfolio of investors who used bank statement loans and they saw mine and they're like, "Oh my God, your investor doesn't own any of these properties." And I'm like, "Yeah, we kind of did wraps." And they're like, "We don't even know what that is." And I'm like, "Are you going to call these notes due?" And they're like, "Hell no." They're like, "Your people pay on time every month."
That's a big thing because it's the
Yeah.
thing is, and that's the thing. If it's an investor loan,
Mhm.
okay, that's first. It'd be different as an owner occupied loan, and it
Right.
was different. That would be like what the fraud aspect. But if it's an investor loan, as long as you can show like the payment stream is coming in and that 65 or 75, whatever it is, the ratio is these days, 65% I think is what it is off the income is going to
Yeah.
cover your PIT. They're usually not going to care as long as they're getting paid on a regular basis.
Yeah. Well, I know that I read an article recently that the federal government is actually going to be cracking down on investors, real estate investors. And because, of course, the government never likes it when people make money and they don't get a piece of it. And investors, just like with wraps and subject twos and or non-qualified assumptions and wholesaling, and there's all these different ways for investors to make money. And it goes on a HUD, but that doesn't go to the government. The government, if you don't report it, the government doesn't know, and they know investors are making a lot of money. So we have seen an uptick in letters, occupancy letters coming from loan care, right? And they're specific to FHA loans. Because when people get an FHA loan, especially if they get an FHA loan with down payment assistance, they signed an agreement that they were going to live in this property as their primary residence. And if they allow an investor to come in and do a non-qualified assumption and take over that payment, and then that investor in turn sells it, on a wrap, and there's an end buyer, I think we're going to actually start seeing more and more of that. And I think that it's going to put people in a precarious position. So my advice to investors who are doing non-qualified assumptions or reps or whatever or subject twos, ask that seller, did you get down payment assistance and do you have an FHA loan? And if you have either of those, how long have you been in the house? Because with down payment assistance years, it's 5 years.
Well, it's also important that should also show up too on a title search too as being a
Yep.
lien on the property as well, like a second, correct?
Yep, it should, but a lot of investors don't use title companies.
Well, that's why you still need to pull a title report in every property. You're not going
Yep.
to have to close at a title company, but get title, pull a title update so you see what you're signing up for as an
Yeah.
either taking the property for subject to or non-qualified assumption on
Yep.
that stuff there. And I want to go back to comment you meant about a 1003 report. That's a loan application. Everybody, I don't know. Calyx point was what we used to use back in the day, and something like there's all
That's what
sorts
I
of them.
use. I still use it. I think it's literally classified as a dinosaur.
It is, but it still looks. But the great thing is when you're creating paper, if you ever plan on selling that paper, you want it to look as uniform as possible to institutional debt. And when we were doing all our stuff, there were, people get our loan files. They're like, "Oh, this is a hard money loan." I'm like, yeah. "Oh, you did a 1003?" I'm like, "Yeah, I want it to be clean paper. It's gonna have all the
Yep.
disclosures. I want everybody to look anything that looks off the normal." Like, I'll give you a great example, Nirvana. Literally this morning, I get somebody email me, "Hey, I got a note for sale. It's a second on a property in Phoenix." I'm like, "Okay, whoopie, did you use it?" "I don't know." "It's an $88,000 loan, and here's the payoff. Nope, no payments. 12% interest only. No payments. The balloon is due in either January 2022, or if you sell the property, or you refinance." And the guy has collected zero payments.
Oh my gosh.
And I'm like, "Well, first of all, it's not with a third party servicer. You have an unenforceable balloon in there because you already allowed this guy to be in it for 4 years.
Yep.
No payments coming in. Nobody's going to pay anything for it. It's not worth the paper it's written on, you know."
Yeah. Yeah, exactly.
And
Exactly.
8 pages on the loan. That was all they had. No 1003 application, no financials. "Oh, I've loaned this guy money for 5 years before." I'm like, "Well, that 80 grand is gone now." You know what I
Yeah.
mean?
Yeah,
Um,
absolutely.
but that's the thing. It's
Well,
important. It's uniform. I'm sorry. Go ahead.
yeah, no, and you know what's funny? When I started this RMLO company, I learned some things about interest rates, right? Like, because I was always like, oh, don't go past 11.99, because once you get into 12%, it's usury. And of course, I had a few investors who were like, I don't want to charge interest at all. So 0% interest. Let's just, let them make the principal payment. So I learned that in Texas, it's not 12%, it's 10%. So anything over a 10% interest rate in Texas on a wrap loan, because it is a second, they can't charge a settlement fee. So, like that settlement fee to the title company, they can't charge that to the borrower. They also can't charge the servicing setup fee. And they also can't charge the monthly servicing fee. So that's something I learned in the audit, was that. But I also learned about the minimum interest rate. So apparently, and I'm not a tax advisor, but I learned this, so you should ask your tax advisor. Apparently, if you charge 0%, right, on this note, the IRS is going to tax you like you are receiving, what is it, 4.6 or 4.5% interest. So I just learned that in the last, 6, 8 months. I didn't know that. So yeah, it's not just the high end, it's also the low end.
Yeah, and I find that so well because it's the second I get it, but I always find it difficult. I remember back in 2008, 9, 10, 12% interest rate on an investor loan was pretty normal
Yeah.
in a lot of cases. I know that the state of Pennsylvania, the Attorney General, that cracks down on contract for deeds at 9.9% because they call that well, usury. I'm like, wait a second, I'm allowing somebody to get in the house.
Right.
They can't get
Yep.
a 7% interest rate now. Now you're
Yep.
limiting what I can make, even though it's a very normal 9.9% across the board. But anyway,
Yeah.
yeah. So that's
Yeah,
something
it's
to keep in mind.
crazy.
So don't go above 10%. Stay at 9.9 is the highest interest rate. Basically, you're charging on a wrap, is what
Yeah,
you're
I
saying.
mean, you can charge more than 10, but if you do, you have to eat that monthly servicing cost. You'll have to pay the settlement fee and you'll have to pay the servicing setup fee. So as long as you're okay doing that, I mean, maybe taking it to, 11.99 offsets that and it's worth it. It just kind of depends. It depends.
Right.
So they
Well,
didn't
because
say
that
it was illegal. It's
right.
just you can't
Well, but
charge
you
them.
do. I'm always a big believer that the last thing you want to do is if you had to take this to trial, you're being sued. Is then if you get more than 12 and charging that, what's the judge going to say? You took advantage
Yeah.
of somebody in a lot of cases, right?
Absolutely. Well, you're walking in the door and everybody hates you,
Yep.
right? Even though you've tried to help people get into a home that can't get into a home otherwise, all that you are the bad guy. And if you can't show that you've done your due diligence and that you are, listen, I'm trying to comply with the law here, then you're going to get chewed up, spit out for sure.
Mm-hmm.
And
So
I
let's.
think that's part of the problem too, is that, because Alan and I talk about this a lot. Most investors haven't ever gotten sued.
Yep.
So until you get sued, you really don't care. You're like, why do I care? And some people go into, they're like, no, I want to be compliant, which is great. I think that's great, but I don't think that's the majority. I think a
Well,
majority of investors don't.
I think if you've been around long enough, you've been sued at some point for sure.
True.
You know what I
True.
mean?
Yeah. But think
But if you're
about how
brand new,
many,
yes, yeah. If you're brand
yeah.
new, for sure.
Yeah, well, because when you're brand new, all you care about is, oh my God, because can I make 150 grand on this transaction because I watched a YouTube video and they told me I could.
So true. So let's go back. So making sure that they're filled out a form. They brought in copies of bank statements, however they're making their payments.
Mhm.
Um, if you'll do if it's a CISA loan, stated income, stated assets,
Yeah.
that they've got a pretty good score. What kind of debt to income ratios are you looking for? Is a requirement, or you don't want to get above to make sure that they have that ability to repay that loan back? Is there any requirements set by the state?
No, there's actually not. But what it is, and in my years of experience with that, my general rule of thumb is 55.
Yeah.
And I say 55 because you can get an FHA loan at 55% DTI, right? Special criteria, but still. So to me, that 55 is still, it's high. That is high, but it's still a good, you shouldn't go above this.
Hmm.
I have plenty of investors who do. And my as an RMLO, the investor is the underwriter. The investor can technically do whatever they want. I'll make notes in my file. I will, discuss DTI with investor. Investor chose to accept it. Here's why. Some investors just flat out don't care. They don't even care what the DTI is. They don't even look at it. What they look at is how much money are they putting down? Right. So if they're putting a whole bunch of money down, but their debt to income ratio is 75%, they're like, I don't care. My guidance is 55.
Yeah,
It's
that's probably the better. That's a better run, I would say, because I literally got a list in this morning of 1,500 FHA, VA loans and stuff like that. That where the DTAs are all above 50, they're all in default.
Yep, yep, yep. And after 25 years, I can tell you that the least people who put the least amount of money into a project or a home, they don't care. They've got no skin in the game. They're the ones that are going to default. And it's the same with wraps, and owner financing. If you let somebody get into a home with a couple $1,000s, you're probably going to look at foreclosure sooner
Hmm.
than later.
Well, that's why Texas is so great because we can do it so fast here.
I know. I know.
In 21 days, from time of default, stuff like that.
Yep.
Prior to the first Tuesday, if you file everything. But
Right.
that's the
Right.
biggest thing. And it's pretty inexpensive to foreclose here since it's
Yep.
non-judicial. $1,000, $1,500 for an attorney fee for the most part for the time.
Yeah.
Okay, so now are we also with it being a wraparound mortgage? Let's talk about that versus just traditional first owner financing right now. Can they also escrow taxes and insurance in that as well on the second?
Yeah, so that's actually a requirement
Okay.
for a wrap. You have to have escrow for the first 5 years of a wrap transaction. It does, of course, get hinky if the underlying mortgage is escrowed and you do the wrap. And then, of course, the insurance is different when you get that new insurance. So you usually have a couple month lapse where you're waiting for the underlying mortgage to pay that new mortgage out and do the escrow analysis. So that part can get a little confusing. But yeah, escrows are required for the first 5 years.
Do you see any difference in the view whether it's a wrap is to a owner occupant or to an LLC like an investor wrap?
So if it's going to an investor, you actually don't have an RMLO at all. You don't have to have one, and there's no regulation for it. That is not audited by the Texas Savings and Mortgage Lending Group, and they don't even want to look at it. Like when I did my audit, I took out all my LLC loans because they're not part of it. So you
That's
don't
something
have
that.
to, but I have a lot of my investors will still have me do the RMLO, and they are getting smarter and doing personal guarantees.
Hmm,
So
there you
even though
go.
they're closing an LLC, I'm like, let's look at that primary business owner and let's look at that and see what that looks like. Because the company may not have credit and the company may just, I might look it up in Texas SOS and see that it's active and existing. And yes, these are the owners. And I look at the LLC docs and all that, but I'll underwrite the actual owner of the LLC. And I always tell my investors, do a personal guarantee, throw that in
Hmm.
there.
Or a deed in lieu and escrow in a lot of cases. That
Yep.
solves a lot of issues with dragging stuff out
Yep.
when it comes to it, which is that's we're not an attorney, we're not giving you legal
Right,
advice,
right, exactly. Not
but
an attorney, not a tax professional.
that's right. Talk to your attorney. I know Alan has
Yep,
talked about deed in lieu once it gets beyond 90 days of
yep,
making it a
yep,
simple process to be done with it. So there's not any hard feelings and just moving on,
yep.
stuff like that. Oh, this is great stuff there. I'm just thinking, okay, let's change the course a little bit here. Instead of it being an
Okay.
investor loan and a wraparound, let's talk about owner financing. If you own the property free and clear and you're selling on terms,
Right.
it's a lot. I would be willing to bet it's different, a little bit different requirements. Is it would be truly a first lien at that point now, and what you can
Yep.
and can't do?
Yep. Yeah. So with a first lien mortgage, as far as the minimum interest rate and maximum interest rate, you're still going to deal with the same thing, except you can actually go over that 10% and you can charge those fees because it is a first lien. It's not a second lien. So those things are allowed. If you own it free and clear, that's where I say just don't go past 11.99 for sure. But I always recommend escrows and using a servicer just because I I made the mistake of opening a servicing company 2 years ago. And now, mind you, I have done this in my past life. I had built a servicing company in my past life, but I had staff that did the stuff. I built it, if you build it, they will come. I did. I
Mhm.
built it, they came, but I had staff that like took the payments and talked to the people, right? So, and that's what was supposed to happen with this one. I built it. We were supposed to have people take over, staff and blah. Well, it didn't get that big. And I had to answer the phone calls every day. It was horrible. It is a horrible, horrible job. So be nice to your servicer. Be nice to your
Yes,
servicer.
yes.
But it saves so much time and so much headache. And it helps that, because there are, even if you only have one, there are rules with, late fees and late payments and late letters. And especially if you have to foreclose, you need to make sure those letters have gone out at the right times. And people don't, take that into consideration. Because
Yeah,
even
that's
in Texas, where it is easy to foreclose, you still have to follow those rules to get there.
yeah. Now, let me ask you a question, and you may not know the answer to that. With CFPB being gone now, who's cracking down on behalf of the consumers?
Well, I will tell you that, I was in mortgage when that happened, right? Because 25 years. So, and I survived. Um, the CFPB's sole mission was to bust the big guys. The little guys never got affected, and even going after the big guys, they gave them chance after chance after chance to rectify and stuff. So, from a little guy point of view, I don't think you're really going to see a change in that. But I think what you're going to see is the states will
Yeah.
be more, I think a consumer will complain at the CFPB level and CFPB will just defer it to the state and
Okay.
have the state open an investigation. That's my opinion. I don't know.
We've gotten a couple letters from the CFPB on stuff that we owned that was non-performing. We either got reperforming or went through the foreclosure process. You never like to see that letter coming in with a demand, but
No.
a phone call, a couple documents, any type of penalty, anything like was waived completely. Like, oh no, you did your job because you did
Yep.
utilize a third-party servicing company to
Yep.
do all that work. So that's the value in that 25, $35 a month that you're paying a servicing company to collect on your behalf,
Yeah,
right?
absolutely.
You know.
Absolutely. Because it's so easy to make mistakes. It really is. We're all human. We are all human. We all make mistakes. But if you're an investor that's got a, owner finance transaction or a wrap transaction and you didn't do your due diligence, that can cause serious, serious problems for you.
Yeah, especially if you're doing it on a regular basis. All it takes is one disgruntled attorney to try to track down everything you can do
Yep.
and go to those borrowers and try to get them to jump on the gravy train, which there isn't a
Yep.
gravy train, but trying to, oh, you're all transactions must be horrible. You're so unethical.
You're right. Right.
And you're not
Right.
unethical.
And the sad part is there's a lot of those investors out there.
Yeah,
And I actually, I made the decision. I've always practiced my business morally and ethically and above not even about being compliant, but about doing the right thing.
yeah.
Right. During the subprime days when all my fellow loan officers were making millions and driving around in Mercedes, I wasn't. I
Right.
still drove my Honda and but I could look myself in the mirror every day and I turned down, I just told people I don't feel like this is the right thing for you to buy a $500,000 house when you are a housekeeper at La Quinta. And they would literally just go to the office right next door
Yeah.
to me and get the loan. But that
Hmm.
was fine. because I would rather, when that whole crash was happening and people were jumping out of buildings and committing suicide, I wasn't, so when I started my own brokerage, and then of course when I started my RMLO company, I want to work with people who like to do the right thing. And I've had several investors come to me, and I know who they are, and I know what they do, and I don't like it, and I won't work with them. I've flat out told them, I'm sorry, I can't. We're not a good fit. We're not a good fit. So
Well, that's the thing is when you're dealing in finances and stuff like that, when you're helping people buy a house, it's one of their most motivated things to do. Often most people deal with their biggest investment for them.
yeah,
And you don't want to put somebody in a bad deal. That never comes out in a good way, no matter what it is. We were doing a ton of investor loans back in the day, and I had people come like, "I'm not going to put you in this loan. A pick up
yeah,
pay does not make sense for you at
right,
all.
exactly,
You're drunk on that
exactly.
1% they're advertising, which is actually 7,
Yep.
and this is going to backfire on you in a few years. I would be surprised though if they start bringing some more of those back based on affordability issues. I don't agree with it, but
Yeah, I know it.
California's a crazy state.
Well, I mean, what, they just brought the 50-year? Are
Yeah,
you
we're
are you
trying to.
insane? Are you
Yeah,
insane? I mean, I've never even put my clients in a 40-year. I'm like,
right.
please don't. I mean, that's the thing that cracks me up about the general consumer is they never look at the truth in lending that shows how much they pay in interest. It's like if you
Hmm.
buy $100,000 house, even at 5.5%, you're paying $250,000 over the life of the loan. And it's
Hmm.
like, you've got that 10-10-10 rule. You get a 30-year loan. Your first 10 years is all interest. The second 10 years is half and half. And the third 10 years, you finally got stuff going towards principal. So you're
Hmm.
doing a 50-year loan. Those people are dead before they even start paying on their principal.
Well, here's the devil's advocate side of it, because I agree 100% with what you're saying. Most people should never be in a 50-year. If you're going to be in
Mm,
that house from start to finish, by all means, get a 30-year, get a thing.
right.
With most people selling after 7 to 10, if you run the numbers on 4% appreciation, and
Yeah.
somebody has a 40, they're still going to build some appreciation and equity in the deal.
Yeah.
Yes, they pay more in interest and their equity's not going to grow as fast, but yeah, I think the longest house I've been was 10 years, and you move and
Yeah.
upgrade or downsize stuff. So you have to take a look at both sides of the situation. I agree. If you don't have any financial savvy and you're begging from Peter and Paul to get in a house, it's not a good idea to do a 50-year mortgage. If you can't
Yeah.
afford a 30,
Yeah.
don't do it. But if you are going to be there in and out in 7, 10 years, it might make sense for you. People
Yeah.
are selling these days. You just have to look at it because it does. I think it opened up when I was running numbers and calculation stuff. It would open up another. People always say, "Oh, it's going to increase property costs." I'm like, no, it's really only going to open up to maybe 5, maybe 10% more people out there as an opportunity for you.
Right.
I don't think paying off your house is a good idea because it's all this equity sitting there that you can't tap into anyway. You know what I
Right,
mean?
right, right. Yeah. Yeah. Well, there's always the pros and cons, and
Yes, of
and,
course.
and
Yeah.
I have a tendency to spout off at my gut feeling, but no, I have to admit that if, once I get a file in front of me and I'm running numbers,
Yeah.
yeah, I'll look at the other side.
Well, you have to. I mean, that's the thing.
Yeah,
We as mortgage,
absolutely.
experts, that's the thing. You look at it's both sides. It does not just one side. Both sides. I agree. Should not be for a lot of. Yes, you'll pay 3 times the amount in interest for sure if you're going to be in there for 30 years or 40 years or 50 years. But
Right.
my first ever loan I did was for my parents to refinance them out of an 18% interest rate. Back in the
Yeah.
day on 30 years, and it made all the difference in the world to them.
Yeah.
It's good when you can help people out with stuff like that.
Yeah,
Um,
absolutely.
so you were talking. Okay, so basically, if it's just a simple, just kind of putting your stamp and docs together. It's what, $700 for for your easy
For my
RMLO package.
easy, my easy, my mini, my
Your
mini.
mini, there you go.
Yeah, my mini. Yeah, where I'm not verifying income, not verifying assets, just pulling credit, reviewing the file and
Yeah.
shooting it over to the investor. Yeah, that's 550 or 700 if I do credit.
Okay.
So and those don't get full disclosures and all that kind of stuff. They get a loan estimate and
But
a truth
till
in lending,
yeah.
and then they'll get an early CD. But I don't do all the, because the full service, my initial disclosures, 150 pages, every state and federally uh, document that's required.
Yep.
I will also do the wrap disclosure if the investor hasn't done it. I'll do that. Then, of course, we wait our 8 days. During that 8 days, I kind of become a transaction coordinator for my investors. I get with title, get their prelim CD. I make sure that there's a survey. Is there a survey? Can I see the survey? Is that around? Are they doing an appraisal? If they do, which most don't, but if they do, I'll help coordinate that. getting with the insurance, making sure that the insurance is one of those companies that will insure on a wrap and make sure everything's right, the mortgagees are right.
Right.
And of course, I send the early CD. Then I start balancing with title. The lender balances CD, and then I've got a few documents that I send for closing to sign for closing.
That makes sense. Are you seeing where the owner finance buyer is paying that RMLO fee, or is it just paid out of proceeds, or is it a mixture?
Typically, it's the buyer that's paying it. I only have one investor right now who pays it himself, but he pays all the closing, and it's land, so he
Oh,
pays
yeah,
all the
yeah.
closing costs. Yeah, he's just a
That's not
land
the same
guy.
thing.
But everybody else, no, they have their buyer pay it.
Now, are you still running? Is it still was it a somebody's buying an owner occupant, still 4% maximum fee on fees and everything like that too? If it's a low
Five.
balance loan, it's 5. Okay.
Five.
Yeah.
Yeah. So if it's a high cost mortgage, because I do have one investor that charges a 5% origination fee. So once you get that 5% origination fee and you get my RMLO fee, they're now what's classified as a high cost mortgage. And the only thing with high cost is there's another disclosure I have to send, and of course, it has to have escrow, which they all pretty much do. And then the buyers have to take an actual homeowner counseling class. So this was something that came up in my audit. So they actually have to take a class and show me a certificate. And then the late fee can only be 4%. It can't be 5%. So
What
those are
is that? What is that that class cost? Do you know off the top of your head?
usually they're about $75. It's the same class that FHA
Okay.
borrowers have to take. It's a HUD. It's the HUD homeowner counseling class. So it's
Hmm.
usually $75.
So I like that because most people think about just owner financing and putting the rate in terms, but charging points, origination points on an owner finance transaction. That's a little different thing I hadn't heard of. I've forgotten about that. You could do that.
Yes. Yeah. A lot of my investors don't.
Right.
I've got some that'll do maybe a point, maybe two. But usually, like my investor that charges 5, they're also the investor that goes out and buys the property for the
That makes
borrower.
sense.
So they're taking a higher risk because that
Yeah.
underlying mortgage is in their name. You know what I
Yeah,
mean?
that
So
that makes sense definitely if they're going out and actually
yeah,
closing on the transaction themselves and
yeah.
the transfer title. What was I else going to say? Have you seen a lot of sale due on sale clauses coming on the owner finance wraparound transactions?
Yeah. I think actually I had a conversation with one of my investors the other day. They've got 88 loans and 40 of them are in foreclosure right now.
What happened? Or who's the underlying? Is it all the same underlying lender on it?
Well, no, I mean, so they're wraps, right? So they're
Yeah.
foreclosing on their wraps. One of their clients had 21 loans with them
Oh, okay. So they're foreclosing on
on their,
their borrowers.
yes, the
I
end
mean,
buyer.
have you seen where if I took over a property subject to non-qualified
Right.
assumption, and then I owner finance it to somebody, an end buyer? Have you seen any of those like due on sale clauses come due where you have equal
No, I'm
financing?
sorry. Yeah, my brain went in a totally different
That's
direction
okay.
there. No, all I've seen is those lender letter or the occupancy letters.
Okay.
Seen quite a few of those. Now, the investors that I work with currently and have done loans for in the last 3 years, I haven't heard of any of them getting the occupancy letters, but I've heard in the grapevine that those are coming out and that those are coming, and a lot of investors have gotten them. They all seem to be from Loan Care right now.
Hmm.
But Loan Care is one of the big servicers for FHA loans.
Yeah.
So that's what's kind of driving that. I think Sohail, do you know Sohail? He's a servicer for Provident. Sohail's
Yep.
great. He
Yep.
calls it title scrubbing.
Yep.
So right there, title scrubbing. He's a good servicer. I was a bad servicer. He's a good servicer.
Well, but no, you're not. You like had a great idea, thought this would be good, and realized
Yeah.
it wasn't worth your time because when
No.
you look what you're charging, 35 or 15, it's just not worth your time, even if it's a
No.
VA over in the Philippines answering the phone calls or dealing with the
Right.
paperwork.
Right. Yeah, no, servicing is not my jam.
No, it's
No,
just
I'm
not my
good. I'm good.
bag.
I like
Servicing
to
is not my
smile.
bag.
Yeah, I like to actually enjoy coming to work, and a
Mhm.
servicing does not do that.
Yeah.
No.
No, it's not because it's never when the phone rings, it's never usually a happy camper of some sort. They usually got an
Never.
issue. Yeah,
Never.
yeah.
Never.
We had a
I'm
gal that
gonna stick with origination in RMLO. I'm good there.
there you go, there you go. And so for somebody looking at owner financing and using your RML services to sell a property, you're licensed in Texas and Oklahoma for those stuff. If it's the properties here
Yep.
locally and you're financing it locally, right? Basically.
Yep. 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 Texas
And
and
then
Oklahoma.
And then what do you specialize, or you're just doing all the stuff when it comes to traditional mortgage lending on your mortgage license or mortgage company?
So my other company is Vintage Home Loan, and Vintage Home Loan is a full service brokerage. Staying true to my heart and soul, I do not live in a box. Um, my loan products that I have with Vintage Home Loan literally range from hard money to USDA. And everything in between. I have the full investor platform, including ground up construction. I have the full first time home buyer gamut, Fannie, Freddie, Govy, all of them. And then, of course, I have all the specialty non QM stuff for, bank statement, 1099, manual underwrite. I've got all kinds of stuff. So I'm kind of become the go-to for my friends who work for companies that are Fannie, Freddie, Govy only, overlays, things like that. If they get a borrower denied, they'll actually send them over to me and say, hey, can you do this loan for my borrower? And I'd say 6 out of 10 times, I can do it. So I love it. I love it.
You are a unicorn, knowing
I
both
am.
sides of that both sides of the institutional debt and investor debt, I have to
Yeah.
say,
Yeah. Well, and it's like because with my history, I started at Bank of America, right? It's like everybody started at a fast food place, right? Your very first job was either Burger
Bank
King or
One and Chase back in the day.
yeah,
Yep.
I was Bank of America. I started there, but as I moved through my career, I worked for banks, I worked for credit unions, I worked for QSOs. I got hired by a credit union, and they just let me go. They let me go free and just said, make me money. And I developed non or portfolio loans, got it out there to my local brokers, said, sell this, and did underwriting, wrote all the guidelines, sold in secondary. So my experience is vast and all over. But what makes me happy is I don't live in a box. And
Hmm.
so if I have a borrower, I don't like to say no.
You
So if
like
they
to
come
scratch
to
that
me,
proverbial financing itch one way or
yeah.
another. Yeah.
Yeah. And I'm old school, got to lay all the paper on my desk and I'm looking and all this paperless lending and all that. That's why I use Calyx. Calyx is old. It works and I can use paper and it's okay. I love
I was
it.
going to ask you, is there any AI tools? I mean, you may not be using anything, but you've heard of any AI tools as far as like underwriting on your traditional files versus the owner finance stuff? Because obviously the owner finance can be so different across the board, but on your traditional side,
Oh,
institutional
I'm a
side.
broker. I'm a broker, so I don't have to worry about any of that.
Okay. All right.
Right?
Very, very good.
I look at it, and if it looks good with my old school eyes, and it passes the muster, then I let the lender deal with that. I'm trying to warm up to AI, but I'll be honest, I just purchased my very first CRM, and I think they wrote it in Chinese. And all of the classes are in Chinese because I've taken like 4 tutorials with them and I still don't understand it. I'm like, I think I crossed that point, right? I'm 52. So I've crossed that point where my brain doesn't absorb technology.
I'm just a couple years behind and I completely cloned myself for with all my information and stuff like that. But that led me to when you're doing the owner financing stuff, let's just say traditional owner financing, free and clear, owner selling it to on terms. Are you seeing folks who's the servicing company that's handling all that owner finance stuff? Is any of them out there? Do you have a couple that you
Yeah, no,
like?
it's the same ones. I think
Okay.
what there's August REI,
Yeah.
Provident, of course, with Zohail. There's Jenny. I don't remember
It's
Jenny's.
okay.
And then there's a new one that's coming on the block, Ziggy,
Yeah.
Ziggy.co. I've met with those guys. They're very high tech.
Hmm.
And I think some of the stuff that they're getting ready to roll out for their investors, I think is going to be nice. It's something that I know the other servicers don't do. But yeah, I just always tell my investors, here's the list, call them all, see who fits your
Yeah.
bucket, who, because You need to know the investor side, not only the consumer side. You know,
Right.
what reports am I going to get? How am I going to get my payments? All that kind of stuff. So, but
How
there's
easy is it to read my reports on who's paid or who hasn't paid for the month?
yes, yes. So, but you know, the ones that do the wraps and the subject twos are the same ones that can do your owner financing because they
Exactly.
specialize in working with notes. You know, they don't
Hmm.
really care what the note is.
What's your biggest pet peeve when a new investor who's going to do owner financing or a non-qualified assumption calls you up? Don't call you unless you've got a file folder, it's under contract, all that stuff. Or what's the thing that
No,
you
I
just
think the biggest thing for me is if you want me to do the wrap, you need to give me the information that I need for that wrap, right? So I need that underlying mortgage statement. I need the underlying mortgage or the underlying insurance policy. I need those.
yeah.
So, and I think investors forget that even if I send out my initial disclosures, but I haven't sent out that wrap and they didn't do the wrap, we can't start that 7-day clock until that wrap is signed.
Mhm.
So, you know, and I'm one of those, I'm very methodical, right? I go down my spreadsheet every day. I go down my spreadsheet, start at the top. Okay, this loan, here's what I need, this loan here. And I send emails every single day to follow up on stuff and make sure that everybody's moving in a forward direction. So that's the biggest thing for me. Other than that, I mean, I'm so easy to work with, to be honest. You know, you can call me with somebody, you can email me with somebody, you can text me with somebody, you know, because I'll just take it. I'll take it and run with it. So,
There you go. Now, the 7 days, is that different from the 3-day right to rescind as well?
well, so it's an addition to. So
Okay.
after the initial disclosures and or the wrap disclosure are signed, you have to wait 7 calendar days before the early closing disclosure goes out. Once the early closing disclosure is signed, then you can close 3 days later.
Okay. That's the
Yeah.
biggest thing, folks. People don't realize that
Yes.
in some cases it's a 10 days at the minimum. There you're looking for stuff.
And that's if everybody does what they're supposed to do,
That's a
right?
big if. That's a
Yeah.
big if. It
I
never
like I
happens. Come
usually
on.
say 15 days because
Yeah.
you know if I send an application to a borrower and they don't respond for 3 days, you've lost 3 days. You know,
Hmm.
or I send the whole package to the investor for approval and they don't respond for a week, we've lost a week, you know.
Yep.
So it's all dependent, it's the human factor, right? So if everybody does what they're supposed to do when they're supposed to do it, 10 days. But
If, but
15.
I would say just plan on 45 days if you're trying to close on anything for the most part. From the time that docs are closed, I mean, docs are signed, plan on 45 days if you just follow. If it closes sooner, great, but
Yeah.
let's just be realistic. Even a traditional closing is not closing in 3 weeks for the most part in a lot of
No,
cases.
no, 30. I usually say 30 days.
Yeah.
You know, give me a 30-day contract on the conventional side or the owner finance side. Give
Yeah.
us 30 days, then we got time. And, you know, because everybody forgets too that it's not just the investor and the borrower.
Yeah.
You've got a title company, you've got an insurance company, you've got the RMLO, you've got all these parties involved. And guess what? As much as we might treat you this way, you're actually not our only file. So
Mhm.
I'm not sitting here at my desk working on your file 24/7,
You
right?
sure about that, Nirvana? Come
I
on now.
know, I know. I make you feel that way. I make you feel that way. But yeah,
Good stuff. Because well, this has been awesome. What is the best way for our listeners across the Lone Star State or across the country
right.
to connect with you and reach out to you?
I would say Nirvana, and that's NIRV as in Victor, ANA at nrtdservices.com. Or my phone number,
Awesome.
832-910-8985.
We'll put that information in the description for you guys, or scroll
Awesome.
down below if you're listening to the podcast. You can see the information on the episode or in the description on the YouTube video as well. This has been awesome, Nirvana. It's been a lot of fun.
Yes, thank you so much for having me. I'm so glad you reached out and we got connected. And I look forward to coming to some of your events. I
Yes,
think actually
definitely.
I'll be there. What? Tomorrow. Is
Well,
that
we don't have an
tomorrow?
event tomorrow, but we do have coming up in February here in Austin. So it may very well have you come out and speak at the event in the third week of February as well.
Yes, yes, definitely.
What's
Yes.
going on tomorrow? Is Alan moving offices finally officially tomorrow? Something like that? Is that what's going
I
on?
am going to I'm going to yeah, I'm going to be there for that. I'll be in Austin. I think they usually do it at Goosehead though. I think we'll do it
Yeah,
there. Yeah,
yeah.
I don't think we're doing it at the new office yet. At least I haven't been told, but maybe they haven't told me on purpose.
I gotta go. I gotta go pick up a bottle of cherry flavored 12-year-old Macallan for him because he said it was
Oh,
his
perfect.
favorite. There we go.
Perfect.
So,
Perfect.
well, good
Awesome.
stuff. Thank you so much, Nirvana, for coming on here and
Thank you.
really enlightening us with all the ins and outs. 'Cause it is a changing landscape here in Texas. And as you guys heard here, first ever release of this information because it's so brand new out there. So,
Yes. Awesome. Thank you, Scott.
thank you. All right, guys, again, that's going to wrap it up for this episode of the show. Make sure you hit the subscribe button, share it with somebody else out there, and go out and take some action. Reach out to Nirvana either via email or phone and get rock and roll. Get your files doing by a true expert who understands both the institutional and the investor mindset. And you do
Awesome.
that, we'll see you at the top.